Warren Buffett is renowned for his wisdom in the world of investing, and one of his most famous quotes continues to resonate with both seasoned professionals and newcomers alike. This statement has become a guiding principle, shaping the way many approach financial decisions and market strategies. In today's rapidly changing investment landscape, its relevance remains as strong as ever. By exploring the deeper meaning behind Buffett's words, we gain valuable insights into the mindset required for successful investing. This section sets the foundation for a thoughtful analysis of the quote, inviting us to consider its enduring impact and practical implications in modern finance. Many investors have come to view a popular quote as permission to purchase well-known, expensive stocks without considering their true value. This widespread misinterpretation can lead to risky investment decisions, as it encourages people to overlook fundamental analysis and price discipline. When investors chase high-priced stocks simply because they are in demand, they may expose themselves to significant losses if market sentiment shifts. Understanding why valuation matters is crucial, since paying too much for any asset can erode potential returns. By recognizing this problem, investors can avoid common pitfalls and make more informed choices in the market. Let's take a closer look at the words wonderful and fair, which are often used in investment discussions. A wonderful business typically refers to a company with strong competitive advantages, consistent profitability, and long-term growth prospects. On the other hand, fair describes the price at which the business is valued, not too expensive, but not a bargain either. Many retail investors mistakenly assume that any well-known or popular company is automatically wonderful, or that a fair price means a guaranteed good deal. Misunderstanding these terms can lead to overpaying for stocks or investing in companies that lack true long-term potential. Recognizing the difference is crucial to making smarter investment decisions and avoiding costly errors. The origins of this quote can be traced back to the profound influence Charlie Munger had on Warren Buffett's approach to investing. Early in his career, Buffett was known for cigar butt investing, a strategy focused on buying undervalued companies with just a little value left to extract. However, Munger encouraged Buffett to look beyond short-term bargains and instead seek out businesses with the potential for long-term growth and compounding returns. This shift marked a significant evolution in Buffett's philosophy, steering him toward companies with durable competitive advantages and strong management. As a result, Buffett's investment strategy became centered on quality and sustainability, rather than merely chasing undervalued assets. The partnership between Munger and Buffett not only transformed their own success, but also reshaped modern value investing. From the analytical viewpoint of Warren Buffett and Charlie Munger, a truly wonderful company is distinguished by several key attributes. First, it possesses a strong competitive moat, which protects it from rivals and ensures long-term profitability. Such companies consistently achieve high returns on invested capital, demonstrating their ability to generate substantial profits from each dollar invested. They also require relatively low capital to maintain and grow their operations, allowing for efficient use of resources. Finally, honest and capable management is essential, as trustworthy leaders safeguard shareholder interests and steer the company towards sustainable success. Together, these qualities form the foundation of what Buffett and Munger consider a truly outstanding business. The term fair price refers to a conservative estimate of an asset's intrinsic value, rather than just its current market price. This distinction is crucial, as market prices can fluctuate due to sentiment or short-term factors, while intrinsic value is based on fundamental analysis. By focusing on fair price, investors aim to avoid overpaying and to make decisions grounded in careful evaluation. The concept of margin of safety remains essential, providing a buffer against unforeseen risks or errors in judgment. Valuation, therefore, continues to play a central role in prudent investing, guiding decisions beyond the surface level of market movements. The margin of safety is a fundamental concept in investing, but its application can differ depending on the type of company. For fair companies, which typically have average business prospects, the margin of safety is often found in their assets. Investors look for situations where the value of tangible assets exceeds the market price, providing a cushion against potential losses. In contrast, wonderful companies possess strong earning power and durable competitive advantages. Here, the margin of safety is derived from the reliability and growth of future earnings. Over time, Warren Buffett shifted his focus from asset-based valuations to emphasizing earning power, recognizing that exceptional businesses could compound value far beyond their book assets. This evolution in approach allowed him to invest in companies with enduring profitability, even if they traded above their asset values. The concept of the quality trap highlights a common pitfall among investors, misinterpreting what truly defines a high-quality business. Often, investors are drawn to companies with impressive growth rates or strong brand recognition, assuming these traits automatically signal enduring quality. This misconception can lead to overpaying for stocks that are merely popular, rather than fundamentally sound. True business quality is rooted in factors like sustainable competitive advantages, consistent profitability, and resilient cash flows. When investors focus solely on surface-level attributes, they risk overlooking underlying weaknesses. Ultimately, distinguishing genuine quality from temporary appeal is essential to making sound investment decisions and avoiding costly mistakes. The Nifty 50 refers to a group of popular blue-chip stocks that dominated the US market in the early 1970s. Investors believed these companies were so exceptional that they could be bought at any price, regardless of valuation. As enthusiasm grew, share prices soared far beyond reasonable levels. However, when the market corrected, many of these stocks suffered dramatic declines, erasing years of gains. This episode highlights the risks of purchasing even the best companies at inflated prices. Over the long term, investors who bought at the peak experienced disappointing returns, underscoring the importance of valuation in investment decisions. The Nifty 50 bubble serves as a cautionary tale about the dangers of ignoring fundamentals in favor of market hype. During the tech stock boom of 2020 and 2021, investors found themselves drawn to companies that promised rapid growth and captured widespread attention. Much like previous market bubbles, many overlooked fundamental factors such as reasonable pricing and sustainable business models. The excitement surrounding technology giants and emerging startups led to soaring valuations, often disconnected from actual earnings or long-term prospects. This period saw a surge in speculative investing, with individuals and institutions alike chasing trends rather than assessing intrinsic value. As history has shown, such patterns can result in sharp corrections when market realities set in. The tech boom serves as a reminder that enthusiasm and popularity do not guarantee lasting success in the markets. By repeating past mistakes, investors risk significant losses when optimism gives way to more cautious assessments. Venturing beyond your circle of competence can expose investors to significant risks. While Warren Buffett's advice to stay within what you understand is often repeated, relying solely on this quote without thorough analysis can lead to costly mistakes. True investing requires a deep understanding of the businesses and industries involved, supported by careful research and evaluation. In contrast, speculation is driven by guesswork and hope, lacking a solid foundation in knowledge. The difference between investing and speculation lies in the discipline to analyze opportunities rigorously, rather than chasing trends or acting on popular wisdom. By respecting your limits and committing to diligent study, you can avoid the pitfalls that come with overconfidence and insufficient preparation. A prudent investor approaches the market with a structured framework, beginning by developing strong business analysis skills. This involves understanding how companies operate, evaluating their financial health, and assessing their long-term prospects. Once equipped with these insights, the investor builds a list of wonderful companies, businesses with durable competitive advantages and consistent performance. The next step is to calculate fair prices, using valuation methods to determine when these companies are attractively priced. Finally, patience becomes essential, as waiting for optimal entry points often yields better long-term results. By following this disciplined approach, investors can make informed decisions and increase their chances of success. Warren Buffett is renowned for his disciplined investment approach, especially during times of market panic. Rather than reacting impulsively to sudden drops in stock prices, he patiently waits for opportunities where companies he has thoroughly researched become available at fair or undervalued prices. This method requires extensive preparation and a deep understanding of each business before any purchase is made. By adhering to this strategy, Buffett avoids the emotional pitfalls that often accompany market volatility. The result is a sense of peace and confidence, knowing that each investment is grounded in careful analysis rather than speculation. This approach not only helps preserve capital, but also positions him to benefit from long-term growth when markets recover. The quote outlines a disciplined, four-step approach to investing. First, seek out a truly exceptional business, one with enduring qualities and strong prospects. Next, take the time to understand its operations, competitive advantages, and potential risks in depth. Only then should you consider purchasing shares, and even then, only at a price that reflects fair value. Finally, always ensure there is a margin of safety to protect against unforeseen setbacks. The message cautions against taking shortcuts, emphasizing that careful analysis and patience are essential for long-term success. Disciplined investing is more than just a strategy. It's a pathway to greater safety, peace of mind, and long-term financial ease. By staying committed to your plan and making informed decisions, you can navigate market fluctuations with confidence. Reflecting on your goals and progress helps reinforce these habits, ensuring you remain on track. As you continue your investment journey, consider what topics or questions you'd like to explore further. Your engagement and curiosity are key to deepening your understanding and achieving lasting financial well-being.